Hey guys, welcome into the Falaya Focus studio, where today we're here with Sterling Chapman to talk about all things real estate investing and kind of give you some of the best practices and ideas on how to get started and how to maintain a real estate investing business. Welcome, Sterling.
Hey, thanks for having me.
Yeah, thanks for coming on, man. We've seen, a lot of great things that you've been doing on social media throughout the state in Baton Rouge. Your name just keeps coming up and up and up every time I talk to people about real estate investing. I'm just wanted to bring you on the show to kind of highlight you and everything that you're doing for the Baton Rouge community and investing in real estate.
Awesome. Well, thanks for having me.
Yeah, no problem. So I guess let's just see. Everybody wants to get started in real estate investing, right? Everybody's like, it's like these things where you watch HGTV shows and you're like, I want to do real estate investing. I want to be Chip and Joanna.
Yeah.
Like, how did you get started in real estate investing and get the ball rolling?
So I guess how you would get started is the answer is going to be different across everybody based on like what resources you have available, what, experience you have,
Sure.
what finance, all that kind of stuff. So for me, what happened was I had a W-2 job with a big telecom company where I was moving up quickly. And I was gonna be the next CFO. That was what I wanted to do, and I just wanted to be Mr. Corporate America. And somewhere along the way, I took an entrepreneurship class in my MBA program in 2017. I was like, I'd love to do something for myself, but I don't really know how to do anything, And I wasn't like really smart enough to go start a business in any particular industry, And then I read Rich Dad, Poor Dad, and I was just like, oh man, like my mind was blown. I was like, I should probably learn more about real estate investing. So then I started listening to Bigger Pockets and reading a bunch of other books. And so from February of 2018 to June of 2018, I must have listened to every Bigger Pockets episode and read every real estate investing book there was. And I bought a single family house. So I saved up. I put a down payment down. I think it was at the time they were doing like 15% down. The house was $72,000. I put like with closing costs and everything, like $14,000 at the closing table, and then spent another like $3,000 to $5,000 fixing it up. The note, the principal, interest, taxes, and insurance was $560, and I rented it for $1,060.
Wow,
so
that's pretty good.
I was like, boom, $500 a month. I'm going to be rich, And I did it one more time a month later. And the next one, it was very similar numbers, but I was cash flowing $600. I was cash flowing $600 a month, and then I was completely out of money. And so I got to the point where I turned off the audio books and the books because it would just piss me off that I couldn't buy more stuff because I was like, it was going to take me another year to save up another down payment. And there was instead of doing that, I decided to start learning more about more creative strategies. So that's when I got into BRRRR investing and seller finance opportunities. And so I guess my first big deal was I found these two duplexes that were distressed. One of them had flooded, one of them had just been damaged by a previous tenant, and I got them under contract. And I didn't have any money or any experience or, no track record. Like nobody was going to invest with me, but I went to a buddy of mine who flipped houses, and I was like, dude, I've got these deals and I think they're going to be like really good deals. So like, I'll give you the contract. If you fix them up, like use your investors' money and manage it from your experience and with your investors, I'll do a cash out refinance at the end. You just add me on title. I'll do a cash out refinance at the end. And then like, I'll pay you $50,000 for all your trouble and we'll pay back your investors for all that. And it worked out. And so those two duplexes, we bought them for, I think $190 and spent $60,000 rehabbing them, paid him $50,000. And then they appraised for $390. So we did a 80% cash out refinance. The bank wrote me a check for $312, paid off the investors, paid him, walked away with, $80,000 in equity, or $78,000 in equity, and a few $100 a month from each duplex in cash flow.
I mean, that's unbelievable,
yeah.
Right? That's just like pushing it up the hill and getting it rolling,
Yeah.
I mean,
and from there, I just kind of kept going, negotiating seller finance deals with lower down payments, did some partnerships in the early days, borrowed cash. What I would do is I'd borrow private money, and I'd go to an investor, or, I say investor, anybody who has money,
right,
and say, hey man, you give me $100,000, and at the end of the year, I'll give you $120,000. And here's a promissory note. And they would give it, and I would take that money and I would go buy a distressed property. Like I'd buy it cash, like a property that needed work, and I'd fix it up. And then once it was fixed up, I'd put a tenant in it, and I'd go to the bank and I'd say, hey, I've got the example I always use is like, say I buy a house for $50,000. I put $50,000 into it. Now it's worth $150,000. Right. So I just created $50,000 worth of equity. So I go to the bank and I say, hey, give me a 80% mortgage on this. They appraise it and go, yep, it's worth $150,000. Here's a $120,000 mortgage. So they write me a check for that. So I pay my investors back or really just roll the money over to do it over and over again.
Right.
And that's how I built up my portfolio in the early days was through that process. It's the same money, just bought 50 houses with it over
right.
you just in rotation.
So how many investment properties do you have right now, or where are you spread out over?
Well, so that is a complicated and evolving question.
Sure. I
have I think I have around 70-ish rental properties in Baton Rouge. I have 11 duplexes, 2 fourplexes, and then the rest is single family houses. I'm in the middle of flipping 16 houses. And then we also syndicate apartment complexes. So I've got a 54 unit apartment complex in Noonan, Georgia, a 70 unit apartment complex in Rock Hill, South Carolina, which is a Charlotte metro area.
Which is booming, right?
And then we're working on a couple other projects in some other areas.
Yeah. I mean, you definitely going outside of Baton Rouge for some of those hot markets and where you can get good value and good appreciation. I mean, it does play well, especially in multifamily, right?
Yeah. So when we evaluate, unfortunately, and I get pushback about this all the time, especially from my Baton Rouge folks, but when we evaluate markets that are like prime for long-term growth, we underwrite the market first. Like that's kind of like our cheat code for like, we know it's going up, right? We look at population trend. Are people moving there or are they moving away? Is it growing or is it shrinking? We look at jobs, right? Are we adding jobs? Is there job growth? Are the jobs that are growing making more money? We look at job diversification. Like you don't want to buy in Detroit, like right before the auto industry goes overseas, right? So you look at like, is there like one major industry or company that could go bankrupt or, that could upset the entire economy, right? Like is the entire local economy dependent on the oil industry? What happens if there's some shifts in the oil industry? And so you look for job diversification, like, Noonan, Georgia is Atlanta. And like I said, Rock Hill is Charlotte. You look at those areas and you've got buku different industries and different major corporations headquartered in there. Like no one specific industry is going to upset the local economy so much that it's going to really make huge, population shifts. We look at crime, we look at poverty, we look at median household income, we look at supply and demand. How many new units are coming on board versus how many we need, So when you run down that gauntlet of like ways to evaluate on a macroeconomic level a market, and you look at like our market, you know what I mean? It's not at the top of the list, and that's not to say nobody can make money here. Clearly, we've all made a lot of money here. Because you buy at a discount because everybody else knows. Like the market is relatively efficient there, right? Like you're going to pay more for an apartment complex in Dallas than you are for one in Shreveport, and your returns are probably going to what just because of the fact that you're buying it at such a discount, So I mean, the market manages itself from some regard there.
Yeah, no doubt. I mean, you got flux. I mean, you could still get a decent return on investment even with a lower,
Sure.
a good cap rate. So, when did you like feel extremely confident in your real estate investing world? Like I started flipping houses.
I'm going to get there next year.
Yeah, next year. Yeah. Okay. You're still working on it. Yeah.
I mean, well, my opinion there is, if you don't feel like you're wearing your dad's suit to work, you know what I mean? You're not really pushing yourself far enough.
Yeah.
So I try and get out of my comfort zone, and continue to grow.
Yeah.
But in the early days, it was that first project that I was telling you about with the duplexes. I didn't sleep every night, for months. Some of the money in there was like some family's money and just like, I had no proof of concept. Like I'd never done it before. I didn't know the process. I didn't know what I didn't know. And I knew that I didn't know what I didn't know. And I didn't know like the bank was going to show up on like the last day. And they did. The banks, the first bank screwed me over. I'm not going to say their name. If you send me a message, I'll tell you who they are. But so I went to some banks beforehand and I was like, hey, this is what I want to do. Like, I want to get added to the title, but I'm not actually buying it. But I'm going to be partial on the title, and we're gonna renovate it, and then we're gonna have a new value. And I want you to give me an 80% mortgage on the property, based off of the new appraisal after we renovate it. And I want it done day one. I don't want like a seasoning period. Yeah, because I'm at that point when you do that, I'm going to use that money to pay off my partners that are on title as well, and we're going to kick them off title. That's how this transaction has to work. I want to be very clear about this. I asked them 4 times before I even agreed to do the deal because it didn't work any other way.
Right, no doubt.
And they said, no, absolutely, that's how we'll do it. We got 2 weeks before closing, and they said, look, the bank doesn't like the appraisal. I was like, it's your appraisal. You ordered the appraisal. I literally don't know who did it.
Yeah, you can't pick your appraiser.
They're like, we'll give you, we'll do 80% loan to cost. I was like, it doesn't work loan to cost. It works loan to value. Like, you know what I mean? Like,
right.
I borrow the money. You give me loan to cost, I still owe people money. And they said, sorry, that's all we can do. So I was traveling for my day job at the time, and I was in a hotel room in Memphis, Tennessee. And I pulled out like Google and Googled like small local banks in Baton Rouge. Pro tip: don't use, big
banks.
Banks. They're
Community
terrible
banks.
for small local community banks for this type of lending.
Right.
And I Googled like small local banks in Baton Rouge, and I wrote down a list of like 20 of them, and I called every single one of them. And I filled out the applications, and I was like faxing in the applications from this like hotel fax machine. And I was like, the first person who says they can do it, I'll do it. And so this lady called me. She goes, yeah, we can do it. We'll be there at the closing table. And so they're still my favorite lender today. And I mean, I work with them all the time because of them showing up for me in that situation. But a lot of banks, before I even asked, and before I found the one bank that said they would do it, told me that nobody would do it, right? You go to Chase or Hancock Whitney or Capital One, they'll say, oh, nobody does that. Nobody's going to do that. That's the key word for banks and lenders that don't do the type of loan that you're looking for, is they'll tell you that nobody does it. And it drives me nuts. It's my biggest pet peeve, because you're either lying or you're an idiot. And either way, I don't want to work with you. You know what I mean? So that's like my pro tip. Call 20 different banks or private lenders or hard money lenders. Like somebody will make your deal work. You might have to pay more. You know what I mean?
Right.
If you're doing some different, type of creative financing a deal, you might end up paying a higher rate, than if you're a first time home buyer who's putting down 5% to buy an FHA. You know what I mean? You're not going to get 3.25%. Well, nobody's getting 3.25% today, but you know what I mean? You're not going to get that homeowner rate, but somebody will do it. And if your spread's large enough and you underwrite it into your project, like, it doesn't matter. I always tell people, like, I don't care what the interest rate is on my flip project. You know what I mean? Like, oh, it's 10%. Great. It's 10% annually. I'm going to have the project for 3 months, and you know what I mean? Like, and I'm going to make $70,000 of it. So who gives a shit if I spent and $4,000 in interest.
It really doesn't matter, right?
Yeah.
It doesn't. So that's I think the biggest thing in real estate investing, and whenever I started flipping houses and getting rolling, is learning how to acquire a house at a reasonable price, right?
Yeah.
It's really, that's the trick. I think acquiring the properties is the hardest part of the whole deal. What is the systems that you've put in place or something to find properties, find things that you can actually work on and make better in the community and make some cash for your investors on?
So as far as single family houses in Baton Rouge, I get all of mine from, I get most of mine from wholesalers.
Okay.
So there's been a handful of times where like my realtor had a pocket listing that he sent me, somebody that he sold a house to a year ago and then it flooded and, hey, I just want to get the hell out of here, and it's not ready to go to market because, typically the retail market doesn't like gutted houses. And, I got a guy who's got cash and he'll close it in 2 weeks type of deal. But most of them are from wholesalers. So I'm really intentional about my relationship with the wholesalers, and that's part of why, we do the meetup and
Sure.
and the podcast and everything is to continue. And that's why I'm always sharing when I'm closing houses on social media, so they see and they go, they know, like Sterling's closing, Sterling can close, because they want those wholesalers. They want somebody who can close the deal,
Right?
Because they've been burned by somebody who's going to try and make it work and then can't show up.
Right. Yeah. I mean, I think relationships are extremely important, and people being able to, know what you're doing there. We talked about that prior to the show, knowing what we do, knowing what you do, so they can bring business to you is extremely important. And social media and podcasts are a big way to do that.
Yeah,
right.
Sure.
You definitely have a podcast too. Let's get into that. What is the Rent Roll podcast?
The Rent Roll radio show.
Rent Roll radio show. Okay.
It's a mouthful as well.
It is.
It's been great.
Yeah.
So I started the podcast in November of 2019. So I read November of 2019, I had 26 rental properties in Baton Rouge, and I was managing them myself, and I was pulling my hair out, and I had a newborn baby and a full-time job, and I was like, man, I don't understand how I can scale past this and continue managing it. And so I was like looking for kind of a way to evolve from there. And I read this book by Joe Fairless called The Best Ever Apartment Syndication Book. And it was about raising capital from investors to go buy apartment complexes and hire professional managers to manage them for you. And it would seem like a solution to my scaling issue. And the first part of that book, it was a great book. I've since interviewed Joe on the show, and I've been on his show. But he talks about in the beginning establishing a thought leadership platform to both build credibility among your potential investors and be seen as an industry leader. And also, it forces you to network. So in the beginning, nobody listened to it. And I said for the longest time, like, I don't care if anybody listens to this. I get my value from the guest, from learning from the guest, from getting an opportunity to network with the guest. There are so many folks that have been on I've had outside of Robert Kiyosaki and Grant Cardone, I've had about every big name in real estate on my show. And, that opportunity only existed. It's easy to get people to talk to you when you have a podcast, I just interviewed Brandon Turner last week. I've interviewed a lot of people that would charge $5,000 an hour for a coaching session. You know what I mean? But I got my coaching session for free because I said, hey, you want to come on my show? You know
right.
what I mean? So it's been great. It's really helped me continue to network. I've built a ton of relationships out of it. It's helped me learn a lot from interviewing over 150 different really successful investors, and it has done its initial job of positioning me as a thought leader in the industry, amongst the viewers. Now, I was looking at the stats earlier today, because I was like kind of like scrolling through my old Instagram posts, and I saw that in December of 2020 we hit the 5,000 downloads mark. So it took me 13 months to get my first 5,000 downloads, and now we're getting 5,000 a month. We're 4,800, so we're right at around 5,000 a month.
That's legit, right?
Yeah,
that's definitely. I do think, putting yourself out there, honing your skills, and like talking to people is extremely important.
I was terrible at it at the beginning. I had a list. I had like a pad with like questions. The first like 5 episodes, I sound like a robot. I'm like reading the same questions like over and over again.
Right.
Nervous, cutting off the guest. Like that.
I think that was the biggest thing for me is like I would talk over people because I'm I'm a loud, aggressive guy. Like that's who I am. I'm a little bit obnoxious. You might like me, you might not. And so I have to like let you talk, right? Because this is really about you telling the story about real estate investing and getting it out there, and then me learning from that, and our users learning from that, right? And being able to grow. And so and it's almost nervous too, because you talk over someone because you're a little nervous and you don't want to let some dead space be out there, but you have to be.
It's rough being the host,
right?
So I love being on shows where I'm the guest. Because I've been a guest on a bunch of podcasts, and it's like I'm always relieved because I never know when it's on my calendar. It just says like Sterling and Bill, and then I like open it up and I'm like, is this your show or mine? And they're like, it's my show. I'm like, sweet, like because I have a responsibility as the host to keep it flowing and to keep coming up with like questions and to keep it interesting and to make the most out of the opportunity to extract it and get it. Whereas when I'm the guest, I just like answer questions and talk about myself. It's just so not as challenging as being the host.
You really just have to show up. And
Show
up and look good. You know what I mean? That's all you got to do, man. But yeah, being the host it's fun too, though, and you get to learn a lot and structure it and be able to be, get better at presenting your ideas and your thoughts. I think that's the biggest thing, right?
For sure.
So obviously we kind of touched on it, but I know the biggest topic, I kind of wanted to let the viewers understand exactly what the BRRRR method is. Could you kind of hinted on it? I think we need to put that out there to where the people can understand exactly what is the BRRRR method.
Sure. So, and it's really the same process we follow with apartment complexes as we do with single family houses. But with a single family house, which you buy a distressed property and below market value. So that's where a lot of people get caught here is every time somebody comes to the meetup and they want to get started, like, can you look at a deal if I find a deal and tell me if it's a good one? I'm like, yeah, sure. And they just inevitably start sending me listings from the MLS. And I'm like, that's probably not where you're going to find a good deal. You know what I mean? And so you got to develop a way to find like off-market distressed properties. There might have been a time where you could find distressed properties in the MLS, but so many people are in the business now that it'll get snagged up, probably pretty quickly.
Oh, for sure.
So you find a distressed property and you buy it. I used to buy them with cash. I honestly don't buy them with cash anymore. I have commercial lenders and like hard money lenders and DSCR lenders. They'll usually like show up and fund like 85-90% of the deal, and then they'll put all of the rehab in a construction escrow budget for you. So you don't. Occasionally, I'll get somebody like I need to close next week, so it's got to be cash. But with those commercial lenders and those hard money lenders, they don't need, the 30, 45 days that a traditional lender would need, right? They're not combing through your bank statements and trying to get you back and forth between underwriting. They basically like my commercial lenders, as quick as we can get the appraisal back, usually we can close.
It's just underwriting the house.
And I know most of the appraisals. So like when the appraisal gets ordered, I'll call them and I'm like, hey, I need that back like the day after tomorrow. So we can usually close with the commercial lenders in a week, you know what I mean? So, or maybe 2, you know what I mean? So it's not, use cash anymore very often. But if you do need cash, what I did in the early days before I knew the commercial banking system like that was I would borrow the money from private money lenders, and I would, so then I'd have a bunch of cash in my account. And somebody would come to me with a deal like, all right, it's not going to work for traditional. They're facing bankruptcy or foreclosure or a divorce or succession or whatever makes the opportunity distressed, where they can't like pour money into it and put it on the market and sell it in a traditional environment. And so I come in and I buy it, and when I buy it, it's usually discounted because it's distressed. And I like to find these projects where I could be all in for 70% of the after repair value. So, if the house is going to be worth $100,000 once I'm fixed up, the most I will pay for the house is $70,000 less the repair cost. So if it is going to cost, $20,000 to make it worth $100,000, the most I'm willing to pay for that house is $50,000. So, I go in and I buy the house with either cash or the commercial bank, and I buy it and it's all distressed. And then I fix it up. And once I fix it up, it's got a new value, right? Now it's worth $100,000. And I put a tenant in it. And once the tenant gets in, then I go to the bank and I say, hey, let me do a cash out refinance, pull all of that money back out. And they'll write you a check for $80,000 and put that $80,000 mortgage on it. And you have the tenant in there that's paying down the mortgage. And if you did it right, the cash flowing a couple $100 on top of it every month as well. And now you got that money back, and you can go buy another house, and you just kind of repeat the cycle over and over again. But that's what people seem to always like not be able to grasp is that it's the same money over and over again. All the houses were bought with the same exact money, just recycled. I bought it, I rehabbed it, I refinanced it, pulled all the money back out, and I bought another one. And I rehabbed it and I refinanced and I pulled all the money back out and bought another one. And yes, I'm racking up a bunch of debt with all these mortgages, but I've got tenants in each house paying those mortgages for me. And the rent is actually a lot more than the mortgage, so I'm cash flowing on top of it.
Right, which is powerful, right? Yeah. Especially, I guess that brings me to another question. Like, so do you do them on 15-year or 30-year mortgage?
30-year.
30-year.
Yeah.
Keep your cash flows.
Well, I mean, there's a lot of schools of thought here.
Do you ever make an extra payment a year or anything like that? You don't do anything.
Absolutely not.
Yeah.
So there's
absolutely
absolutely not.
That was a pretty strong answer.
Yeah. Yeah. So there is there's a lot of concepts surrounding that.
Right.
And so first of all, mathematically, leverage is always the best answer, right?
I would agree.
If
You're
you want
other people's
now,
money.
that's not. It doesn't necessarily always mean it is the best answer. That kind of depends on what the question is. Like my 70-year-old father does not want any type of debt in his life, and he just sleeps better without debt. And he's 70, and that's the peace of mind that he wants. And you know what I mean? No ROI is going to like change that,
right?
And, because at some stages in your life, safety is more important than squeezing the best ROI out of the situation. And so I'm not saying that like it's not a good move. There's a lot of people out there that are worth a lot more money than me that do it that way. So, it can go really either way. But for me, at my age, at my growth trajectory, I want to maximize my ROI and maximize my cash flow and maximize my debt service coverage ratio for the loans I qualify for. And I want to live off of that cash flow, so I don't want a higher note. It gives me flexibility. Sure. You know what I mean? Like if things got tough and vacancy got high, I could pay it. I could always.
What your reserves are. In my opinion, it's like if you got enough to where you could handle a lot of mortgage payments with a lot of vacancy, then maybe you go to the 15 years so the bank isn't taking so much of your equity. But at the same point, like if you can easily cover 2 months of vacancy you know, with a 30-year, whereas a 15-year, you're like toast after 2 months. You know what I mean?
I've seen it.
Like,
I hear
you know?
I hear a weird concept of a lot of people that I want to put more money down so that my note's lower.
No.
Because that makes me feel safer. I'm like, you know what makes you safe is having a bunch of cash.
I would agree. That makes me warm and fuzzy at night.
You can like, you know what I mean? You can handle like stuff going wrong if you're at like a big pile of cash in the bank. Having that equity like stuck in the house, it's not really, you know what I mean? Like you're not safer because your note is, you know, $480 instead of $495.
Like when it's that much, it's like just don't get breakfast this morning.
Yeah.
Eat at home, have some eggs. You know, Jesus. You know. Anyway, I agree. I completely agree with that. But you know, I was just interested to see if you would make an extra payment a year, like because that takes it from a 30-year down to a 19-year or something around about that. You know, if you make it an extra payment a year.
Yeah, I mean, maybe at a different stage.
Yeah.
In my life, I'll consider that.
So I guess that brings me to the next point. Are you moving properties around right now with things, the market being hot? Are you selling things to reevaluate where capital is placed and where
I am. So, early on, I was never going to flip a house and I was never going to sell any of my houses. And what I've found is that my apartment complexes perform more consistently with cash flow than my single family houses, just because of the management you deal with single family houses. And so I'm not selling any of my single family portfolio that I've acquired over the last 3 years. Like I still keeping all my rentals, but a lot of the houses that I'm buying this year, I'm flipping. And the reason I'm doing that is because I want to take that money and redeploy it into these apartment complexes that we're buying. When I look at like the return on equity of keeping those houses, it just doesn't make sense. So, my general rule of thumb and there's some other variables that affect how this goes, but typically, if I find a house that has an ARV or after repair value of like less than $250, then I'll keep it as a rental property, unless it's like in a flood zone and that screws up my cash flow. But generally, like the less expensive ones, I'll keep as rental properties because they can cash flow better.
Right.
And then the ones that are like $250 and above, I'll flip. And I don't really buy anything that has an ARV higher of about $450 from on the single family side.
I completely agree.
I just feel like that's a danger zone when it comes to economic shifts.
Completely agree. I think we talked about that on Facebook a little bit. I think, as you get higher price points, the things change dramatically on what buyers need and what they demand, and then
there's that, and then from like a safety standpoint, like how am I gonna
leverage?
Like I could put a tenant in a $300,000 house if I had to. I mean, it might not be like, it wouldn't be like super cash flowing, but it wouldn't be bleeding very bad. If I tried to put a tenant in a $500,000 house in Baton Rouge where I was getting $2,000 a month rent, like I'd be bleeding very bad every month.
Yeah, it's I don't know.
Keep your eye on having multiple.
Believe it or not,
strategies.
though, like it depends. Like I've had some rentals around the LSU area that were higher dollar.
Yeah.
And believe it or not, they rented for great, like over $3,000. $3,000, and but it was like.
I hear
it's especially. I'm not talking about in Prairieville or in Gittins House. I'm talking about near LSU.
I hear
probably
that a lot.
Professors or executives.
That a lot where people are doing the $3,000 rentals, and that goes kind of back to my recession-resistant, more conservative strategy around. I mean, or maybe it's a limiting belief of my own, but I just feel like if you're paying $3,000 a month in rent, like you're probably about to buy something yourself.
I completely agree.
You know what I mean? Like, what are you doing renting? Now, I mean, we moved around growing up. So I lived in Houston and in Boston and like my family, who was very capable of buying, a house, rented houses. The year that we spent in Houston and the year and a half we spent in Massachusetts. But I don't know how common that is. I don't know. I just feel like your rental pool is a lot bigger at 1,500, You know
It is.
mean?
I mean,
Then
it is a lot bigger. I mean,
Yeah.
but you also get some of those executives where the companies are paying
yeah,
the like it's part of their package or
Yeah, that's
relocation package and stuff like that. And if you listen to some of those other podcasts like Martell, he says to never buy one, never buy a house, always rent, right?
yeah.
And
That's Cardone.
yeah, no, it's like this new guy. He's hilarious, man. Martell Turnkey. Have you heard of him? Look him up, man.
Cardone says never buy houses. He's like,
I mean, I kind of understand. It's the same thing. You could use your capital over here to buy 3 single family. I mean, if you was 300 grand, 400 grand, you could. How many single family houses could you do 80-20 with? A lot. And you cash flow that, and then they pay your rent. So at some level, you could have someone else paying your rent, so you're living for free, and you don't have to worry about ACs and. Anyway, I kind of understand the theory,
Yeah, like house hacking.
Yeah, house hacking.
Yeah,
I mean, it's very.
I put something out the other day on that. That's like when I started, I didn't even know what half of this stuff was until I was like 30. And like I read Rich Dad Poor Dad in February of 2018, and me and my wife moved into our first house in March. So like it really started to like blossom shortly thereafter. And like that was when I like came on the concept of house hacking, and I was like, "Oh, dude, how cool is it? You can buy like a 4-plex or a duplex with an FHA loan with like nothing down, or barely anything down, and rent out the others." Well, no, because I had moved my wife into this like nice house, and there's no way she was going backwards. but like if I'd, you know what I mean?
Right.
If I'd have had the idea before we bought the house and we just moved out of the apartment we were living in into that apartment, it probably would have been like a smoother sale, But
the contractors are doing that constantly.
Man.
Like, dude, the contractors and the contractors' wives, I mean, they probably move every 2 years.
They
live in for 2 years and flip, dude, with a 500K tax-free write-off, man. I'll be doing it too.
I've got some friends that do it.
I mean,
I have no interest in living with my wife in a construction zone.
Right, I know. Trust me.
Well, and we got 2 small kids, so like, dude, after Ida, we had a pecan tree fall through our dining room.
Ooh, no.
And glass go everywhere, and then you got to like paint, and I mean it's just, and having like a 2-year-old and a 3-year-old running around in that, and the AC's all jacked up because the windows open. It's not. I mean, I understand that people make great profits doing it, but it's just not something I'm personally interested in doing.
No, we renovated. We bought a house in University Hills and renovated. It was a old Tudor, and renovated it and took it back and rewired it. But we lived in a separate house, moved in, and then did the exterior stuff after with the outdoor kitchen and stuff like that. But it took. I mean, you definitely don't want to live inside.
Yeah.
While that's going on.
Yeah.
No way.
That's not cool.
But those builders, they're building spec houses, and then they live in it, and then they get 2 years and they sell it, and it's a tax write-off. So they don't ever really live in it.
Yeah.
They're just like building a spec and then move into the spec.
If you live in a house 2 out of the previous 5 years, then you don't have to pay taxes on the capital gains.
And if you're married, it's a lot of money, right? It's like $500K, right? So it's, could be a lot of money cash flow to where you can build your equity, which allows them to build more houses just like you. Bankroll. They got their roll going, so they do that rinse and repeat 3 times. Now they've got $1 million in the bank.
Sure.
And they can now build 10 specs at a time.
Right.
By doing exactly what you're saying, right?
Nice.
That's how they're doing it, right? That's how those builders get rolling. Is doing that. But I bet you that is tough on a marriage. I don't know. I don't know. I don't want to move at all.
Right.
I don't think if I move, it's going to be way out of state and way away. I'm not moving in Baton Rouge anywhere.
Yeah.
Anytime soon.
Yeah.
But anyway, so I guess what is your current thought on the market as a whole for real estate investing? I know we've had a lot of changes in the marketplace with interest rates and inventory shortages, supply chain issues. We've had so many different pressure points, so it's really hard to digest. But what is your kind of general state on real estate investing in the next year to 2 years in front of us, and how do you think it's going to play out?
I would recommend doing it.
Yeah, right.
So-
It's always better to do it than not do it.
So everybody told me in 2017 and 2018, like, it's about to crash. Don't start investing right
God.
now. It's going to crash any minute. And thank God I didn't listen to him. But this is a really complex topic. But at a glance, I would say the housing market specifically should be okay for a while because of the supply and demand.
Completely.
So, interest, like, first of all, we were in like funny farmland there for a while where like the market should never behave that way. So the fact that we're getting back to normal is not like a crazy thing. The interest rates are really just bringing us back to normal. And we have a huge shortage. So we're like 5 to 10 million houses short in the U.S. and we can't build them fast enough. We have all these supply constraints from labor shortages to supply chain issues with the materials. And then, the raising interest rates, like people got to borrow money to build houses. Uh-huh. So that actually prohibits more inventory from coming on supply. So I do not see any huge crash. I mean, it's certainly slowing and normalizing, where I used to get 30 offers in a day. Now I get 5 offers, you know what I mean? So, but it's by all means, it's still a seller's market. And I think prices are going to continue to slowly creep upwards over time. I don't see any, I mean, especially in like a Baton Rouge, Louisiana, right?
Yeah.
When you look at where you see these like really crazy things happening is like a Las Vegas, Nevada, or Miami, or Los Angeles, where you had 300% appreciation over the last 24 months.
Right.
And
We didn't
like,
quite see that crazy town.
You're going to level out. I mean, that's going to dip on you.
Some of those markets had like $200,000-$300,000 over asking.
Yeah, but I mean, the economy as a whole is certainly, I mean, you can't not expect it to be traumatized when you treat it the way that us as a people have treated the economy. I mean, the market and the Fed and the government and the money printing. And I mean, it was inevitable that it was going to overheat and we were going to have to, end up in the situation we're in. But as far as housing specifically goes, I don't see that we have the supply to really, cause some kind of crazy dip.
No, I agree. I think when I did some research and looking back on it, kind of looked at the 70s, right? So the 70s were hyperinflation and had times where we were seeing kind of interest rates spike up. That's when it went up to
20%.
That's when it went to 18, right? At the end of the 70s, right when I was born. And then it crashed in the early 80s. But when the appreciation was happening, right,
Mm-hmm.
the housing prices just kept with them because the appreciation, there's a replacement cost. If you're going to go build it right now,
Right.
guess what? Materials are up. So that single family home that's a resale is going to go up because you can't just go build it over there for cheaper. Do you understand what I'm saying? So it keeps the price inflated. And I do agree that the inventory is an issue, right?
Sure.
And it still is a huge issue. But I actually kind of, as a realtor, love the fact that we're not getting 50 offers at a time.
Sure.
I mean, it was insane. These buyers were running around, and I don't know if you experienced this. I'm sure you did, where they just writing paper. I mean, they would literally throw around offers, and as an agent, I had to like weed through the BS, for lack of a better word, of offers that were legit and offers that were just, hey, I hope I hit. We're playing the lottery, and then they just either can't get approved or they just cancel it the first day in the inspection. Like, I didn't think I was actually going to win, Right. You know what I mean? It was kind of an insane time of real estate,
Mm-hmm.
But I like that.
Hard time to buy as an investor as well.
Oh yeah, because you have so much competition, right?
Yeah.
The retail market is just as much competition as the investor market, which has become bigger and bigger, right? So I do think it's going to continue to go up. But I would like to highlight one thing, and I talked about this in Cypress Title when we had one of these get-togethers like this, and it was a year and a half ago when interest rates were really low. And I was like, guys, we are locking. I mean, it's great time. You're closing how many deals right now? Every lender is making their bankroll for life, $1 million years, and everybody's having closings and refinances. But now everybody is locked in at 3%. Everybody is locked in at a low interest rate. So if they want to switch up to that next home, their switching cost, right, is way higher, right?
Sure.
And so what does that look like from a retail space? Maybe not an investing space, like not what you and I are talking about, from a retail space on a big level. At some point, that's going to be a friction point, because they're going to be like, oh, I got to move over here and pay an extra $1,000 a month to live in that house. No.
Well, on the flip side of that coin, that means they're not leaving the house they're in.
Exactly.
So
right.
They're not selling.
They're not in the market, right? So it'll slow the market. So the demand will slow. The question is, will the supply go up, or will the supply?
Well, what I'm getting at is by not selling the house they're living in to move into another. Like if you sell the house you're in and go buy another house to live in it, we're as a economy, we're net zero, right?
Right.
We gave up one, we opened up one.
Right.
So if they're not moving out of the house that they're living in and opening that house and adding that to the supply, then they're still constricting the supply by staying in it.
They're definitely restricting the supply. There's no doubt. The question is, is the demand going to be inhibited long term because of that, right? Because supply is going to continue to come on from builders, right? And then, but that demand isn't going up, right? These people aren't switching.
Well, I mean,
but I think they always will. Like people your age and will inevitably be in a 3-2, or smaller homes, and they got 2 babies, and now they need 5 bedrooms, and they're going to move up, and they got that new job at the telecompany, and they're going to, so life is still going to happen, man.
Sure.
There's still death, divorce, all kind of things that make the market go, right? So I don't think it's sound the alarms, but what does that play on the interest rates? And I think we're only starting to understand that, if that's going to affect it at all. And that's the only thing I'm saying is it's an interesting dynamic to watch over the next 2 or 3 years on how locked interest rates affect the market.
Yeah.
You know what I mean? And how many people, and I'm sure there's data on that. I don't know exactly what is the average locked rate right now for a 30-year fixed mortgage?
Yeah.
I wonder what it is.
Yeah.
There'd be some interesting data to grab, because I'd love to see on the aggregate.
Well, something that came to my mind recently around buying more rental properties was looking for mortgages I could assume or buy subject to.
That's what I was.
Because there's tons of great debt out there,
dude. I would agree. I think that's
I can't get it today.
That is the next wave of the burr. Yeah. The next wave of the burr is gonna be assuming the mortgage, because you can assume a mortgage at 3% interest.
Now, I don't know how the banks would feel about
I know you're going to have to
you'd probably have to end up doing a subject to.
Subject to, I meant. I said the wrong word, right? Subject to, right? So, but I think that could be a huge wave of, maybe, obviously it might scare some sellers away, but I think there's still going to be a big pocket of people that would be willing to do that, right? And maybe you pay a premium for that, right?
Sure.
At some point, I'll pay a $5,000 over market rate,
Oh yeah.
You know what I mean?
I mean, that happens all the time with creative deals. I got a handful of deals that I paid too much for because of the terms.
Exactly. I mean, so it just could be, you're going to pay for it in a different way, but over the long run, you'll pay less because you got a low rate,
Yeah.
So, it could be, I don't know. I kind of got, whenever I heard that the first time, I got excited. I was like, man, I was like, if I'm not in Falaya, dude, I would be selling that left and right, trying to go get it done and build up a portfolio. So, but I'll leave that to you for now. But anyway, man. So, I guess you kind of talked about it was multifamily, right?
Sure.
And kind of your focus there. What do you think the difference in the state of the market right now? Do you think single family is better or multifamily is better? And do you think there's a a better avenue to attack one or the other?
So I mean, and again, people make tons of money in both industries. I like multifamily. I think that the stuff that's going on in the economy right now is only going to help multifamily. First of all, you've got the raising interest rates, right? Which create a barrier of entry to home ownership. So these people that were going to go buy a home, but now they don't qualify because the note is twice as high, because the rate is twice as high.
They're out of the
Now
market.
they're going to continue to rent, right? And so
right.
they're typically, that's going to drive them towards an apartment complex. The other thing is how inflation impacts the value of an apartment complex. So, the way you determine the value of an apartment complex is a little different than the way you determine the value of a single family house. So a single family house, you use comps.
NOI, right?
With an apartment complex, you use the net operating income divided by the capitalization rate. So the main driver in the net operating income is, it's the revenue minus the expenses. So it's the rent revenue. So to increase the value of an apartment complex, you just increase the rent, and that's what inflation does. Is it increases everything, right? And rent is right there. So the example I always use on an apartment complex is like, let's say you have a 50-unit apartment complex, and you raise the rent $100 a unit.
And then the multiple.
And let's say that apartment complex is trading at a 5 cap, of like a 5% capitalization rate. So you've got $100 a unit times 50 units. That's $5,000 a month. Times 12 months, that's $60,000 in net operating income increase that you caused by raising the rent by $100 a unit for those 50 units. And you divide that $60,000 by 0.05 for the 5 cap, and you just added $1.2 million of value to that apartment complex.
It is. It's amazing when you start doing those calculations, what that can do. And that's also by making them a little bit better too, or doing renovations or anything like that.
Sure.
You can really change the complexity of a multifamily. And it does also vacancy rates, right? I think it's a big part of it. Why I like multifamily, which I honestly don't have any. I only got 6 single family rentals.
Sure.
But I do think that multifamily is way safer of a play for vacancy rates and being able to maintain.
It's easier to manage. It all boils down to.
And that's what I did want to get into. Like, are you now working property management, or do you take it under your own wing? Do you have your own?
I have third-party property managers.
You do.
So I have a third-party property manager that handles my single-family and small multifamily portfolio in Baton Rouge. We have a different property management company that handles the Georgia and the South Carolina asset, and then we're looking at some other ones for some other assets.
Right. So you're kind of taking that off your plate, which is good.
I have
that's I would say
interest in being a property manager. I thought I did. When I started, I was
tenants and toilets, right?
When I started, I was like, I want to be a property manager. I'll manage other people's properties, and I don't want to at all. That's the last thing I want to do. It's terrible.
It is. It's really, really bad. I mean,
and I really enjoy. I came from a sales background, so I managed a sales team throughout my entire corporate career, and so I always liked leasing, because I always felt like I was closing a sale. Like I was talking them into signing the lease to move in, but I was getting stood up all the time, so I'd have to drive across town 18 times a week to go show this tenant to people that weren't even showing up after they told me they would, and then the maintenance issues, and then with the smaller multifamilies in the suspect areas, the tenants are fighting with each other, and I've run into so many issues that I thank God I turned it over, because I almost didn't. And I've said this a bunch of times, and my buddy who was my first property manager, every time he sees me say this in an interview on social media or something, he always texts me and says, "I heard your thank you again." But if I turned my properties over when I had 26 units, and if I would have continued to manage them, I would still have 26 units. The freedom, the mind space, and the time freedom that allowed me so much ability to grow and spend my time doing the other things that I should have been spending my time doing.
No doubt.
So,
It's hard making that step. Like,
yeah, well,
putting
you're giving
Jacob
away
in place and the other people in teams and May so that we can grow Falaya. I mean, it's hard putting those systems in place to make that leap,
investing in your business is a difficult. It's a difficult decision because you look at like the cost going out.
Sure.
Like, I'm going to spend $50,000 doing that. But like every single time I've ever done it, it's been like immediately I was like, oh, that was clearly the right thing to do. It was clearly like beyond the shadow of a doubt the right thing to do. So property management, I was like, oh, clearly that was the right thing to do. I'll never go back to doing that. And then I hired, I've still got all my construction guys that do all my rehabs and stuff, but I hired like an executive assistant as an intern a little over a year ago. And, a couple weeks in, I was like, I don't understand how, like, he's doing all this stuff and I still don't have any time in the day. Like, what was I doing before?
Right.
And then
it just gets spread out.
And then we just hired an in-house marketing guy. And it's the same thing. I'm like, dude, they're both busy like 40 hours a week. And I still don't have any time. Like, what was I doing before? You know what I mean?
It's just growing, right?
And the amount, like, the business pays for itself. I mean, you grow exponentially, looking back over the value that the employees and the property managers and the partners have added. It's, there's just I would be doing so much less. And you got to give away a chunk of it. And it comes back tenfold. It's like, do you want a slice of a watermelon or do you want like a whole grape?
Right. No doubt. Well, we got two more things let's talk about. So the Crestworth Capital, what is that? I kind of want to let people know exactly what that's about and what y'all do.
So Crestworth Capital is my branding identity crisis.
Okay.
No. So Crestworth Capital is the company that I founded in 2019 to raise capital to buy apartment complexes.
Got you.
So
okay.
It's our private equity or our syndication arm.
Got you.
So that business is primarily focused on, like I said, what we do is we raise capital from investors. We go find distressed. I say distressed. No, they're not all distressed. Some of them are just mismanaged.
Right.
We find apartment complexes where there's an opportunity to add value, and we add the value, and we hold them for 5 or 10 years, and we sell them, and we pay our investors a huge payout. Right. And so that's a little different than I feel like I have 3 businesses essentially.
Right.
I've got like the rental portfolio, which is Serenity Home Solutions, which holds all of my my rentals in Baton Rouge. And then I've got Michael Paul Properties, which is my flipping business that I flip all of the houses through. And then we have Crestworth Capital, where we raise the capital to, there's a lot of overlap between, like, the flip revenue typically goes into Crestworth, right? Because when you buy, think about, you buy in a $300,000 house, you got to put $1,000 deposit down. Like, the deposits on a $10 million apartment complex are $250,000. You know what I mean?
Right.
So, and then every time I buy an apartment complex, I'm raising like a majority of it as investor capital, but I have to invest alongside with my investors, right? I need skin in the game, and I think they're great deals. So I always, every time I buy an apartment complex, like there goes 50 or 100K.
Right.
So it's an expensive business, and then the marketing staff, and all of that. It's an expensive business to operate that has a long time horizon on the return. Right. So, the way we structure our deal is very investor friendly.
Okay.
So like you as a limited partner investor in our project gets most of the payouts on the front end, and we only really make our money on the back end when we sell and do really well.
So the investor's getting the cash flow.
Well, the way we do a lot of our projects, we call it a European waterfall. So you as an investor get your money back plus the cumulative preferred return before we really even start tapping into our splits. So we've done that with one of our projects, or this month we'll have our for our Georgia project, 18 months in, we'll hit that hurdle, and now we'll begin to start taking some of our splits. But, we hadn't received a penny from that thing in 18 months while our limited partners were getting cash flow the whole time. And so I say all of that just to say, like, the syndication business, there's a ton of money to be made in it as an operator, but it's like long-term horizons.
Gotcha. So which is important why you have all three
which
arms,
is why,
right?
I flip and,
Right.
and I take and I invest in the operating side of Crestworth Capital.
Gotcha.
And I also invest as a limited partner in my own apartment syndications as well.
That makes sense. It's smart. You got a little bit of everything. And when you're in real estate, you might as well, dip your toes in it.
Yeah,
right?
yeah.
So I guess our final thing, like the real estate investing group, I kind of want to let people know about what you're doing there.
Yeah.
Kind of talk to you about what y'all do with those meetings and what that's all about and why you started it.
Sure. So we've changed the name a few times.
What is it now? I don't even know. That's why I kind
so
of
when we started, it was
the Red Stick RIA.
When we started, it was the Red Stick RIA.
Yeah.
And that's a pretty common name for real estate investor associations across the country. But what we found was, well, first of all, I think it's like trademarked or something.
Is it?
I don't think you're supposed to just like go and jack their name without asking them.
Did they send you a letter?
Well,
like
no,
they
but
sent
some
me?
people told me that, like, hey, I don't think you're supposed to do that. But the real reason we changed it was for people that, we like to convert people, right? We want people
Sure.
that don't know. We're not just trying to like dog whistle real estate investors. We're trying to attract people that maybe don't know anything about real estate investing, and so they come learn about it. And so, the guy who's never done any research into real estate investing doesn't know what a RIA is.
Right.
So they might not know that they want to join that group or go to that meeting. So we changed the name to the Red Stick Real Estate Investors Group, which I'm still not
sold on.
Not sold on, but it only
When
lets
did you start it?
It only lets me change it like once every 30 days in Facebook. So we're stuck with it for like,
Facebook put a cap on you changing, rebranding.
Yeah. So we started it and I started it because my friend John Roberts bullied me into starting it. I didn't want to start it. I was busy, and John was like, "No, it'll be great." He's like, He's like, everybody knows you, and so like I need you to do it with me so people will come to the meeting. He's like, I'll do all the work, but I'm so glad he talked me into it. It's been great. It has blown up.
Y'all been having a lot of people show up.
We've had a ton of people come, a ton of people reach out. I mean, it's been great for both of our businesses. It's been great for the business of everybody that goes in attendance. I've got so many like really cool success stories that have come out in that group. My favorite is my friend Brett that he won't see this. He doesn't have Facebook, but he was like the original one who told me about real estate investing in like 2014. And I think he was the one who told me about Bigger Pockets and to go learn about it. And then he went and did his own thing or whatever. And like we bumped into each other years later at my kid's second birthday party in like July of 2021. And I was like, yeah, dude, like I took all your advice. Like I went and listened to Bigger Pockets. I learned about real estate. I bought all these rental properties and this is how I've done it. And he's like, oh, wow, that's awesome. I was like, dude, come to our meetup and you need to meet these wholesalers and you need to call these lenders and you can burr these properties yourself. And he's like, yeah, okay, I'll do that. And so he came to the meetup and I didn't see him again for 6 months. And one of my wholesalers called me about a deal, or I called one of my wholesalers about a deal. And I was like, hey, you still got that house? He goes, oh, no, Brett bought that house. I was like, Brett who? He's like, Brett Blake. I was like, wait, what? So I called, come to find out the dude went to the meetup, just like I told him, met with some wholesalers, exchanged contact info, just like I told him, called the lenders, just like I told him, and had bought like 10 houses over the previous 6 months. So now he had 10 rental properties and just blowing it up just from following direction. You just go to the meetup, meet the people, use the resources, boom. And it's such a clean, and I mean, you got to know the guy to know how funny it is that he didn't even call me one time through the process to say, dude, I did it and it worked. He wanted to come back and tell me like, ha, look at all this, but it's so cool. Like,
That is cool.
Nobody deserves it more. So I'm super happy for him. But that's how easy anybody can, a lot of times people think like, oh, well, it's not replicable or you're special or you had some kind of advantage. I didn't.
Right.
And I've seen a lot of people. That was why I got into real estate in the first place. Was I went to a meetup and I saw some people that couldn't tie their shoes that were millionaires, and I was like, man, if they can do it, like it can't be that hard, and so yeah, that was why we started, and we've seen so much traction, so many people that started coming and met people there, and now they're working together, and now they're getting deals done. So we really love the growth.
Yeah, I mean, I've been to a lot of those groups in New Orleans and all over the place, and all through Baton Rouge, and went to yours, and yours definitely had some of the best energy.
Yeah, we keep hearing that.
I would say it was definitely something I walked away with. Like, definitely would recommend people to go to it, right? Awesome. Like sometimes you go to these things and it's like stay away but y'all's is it was really good. I want to give you props on that.
I appreciate it.
That I didn't feel bad recommending people to go to it because
awesome.
It definitely had the right energy. So I definitely wanted to highlight that and just make sure people knew about it.
Cool.
So how could people track you down and find you or the Red Stick Route?
There's a bunch of ways. So I'm on Facebook. Sterling Chapman is on Facebook. There's an Instagram. I have Sterling Chapman on REI on there. My new marketing guy just started putting me out on TikTok and YouTube.
Oh yeah, Jacob's got me a TikTok.
Yeah, I don't know how it works. I'm not very. I got about 10 followers.
I'm not very good at it. I don't know the platforms perfectly. I'm definitely like the old dude that's messing it up. Keeps playing the same song. That's me.
And but I mean, anybody can email me, Sterling at crestworthcapital.com. Message me on Facebook, or I'm pretty easy to get in touch with.
Yeah, cool. Well, we really do appreciate you coming on today and telling people about real estate investing and kind of giving them the steps to start the process. And like you said, anyone can do it. You kind of just have to get going, network, get out there, put yourself out there, and you can make it happen.
Awesome. Well, thanks for having me. I really enjoyed it.
No problem. All right, guys. Well, this has been Falaya Focus Podcast Studio, and we'll see you next time. Appreciate it. Hey guys, I wanted to take a second and say thank you for watching the Falaya Focus Podcast. At Falaya, we are reimagining the way real estate is bought and sold. So we need all the love and support we can get to grow our movement. Please tell all your friends and family about all the great things that we have going on here at Falaya. Please like, share, and subscribe to all of our content, and we'll see you next time on the Falaya Focus Podcast.